Hey everyone, and welcome back to The Explainer. Today, we're going to do something a little different. We are looking right past the burgers, the fries, and those iconic golden arches to uncover a totally hidden financial machine. We're breaking down exactly how one of the most recognizable brands on the entire planet actually generates its staggering wealth. And more importantly, we're going to examine the massive, looming roadblocks that could seriously threaten their whole operation. All right, let's dive right in. So, picture your last visit to a McDonald's. It probably looked a little bit like this quiet, moody sunset scene, right? I mean, most of us just see a simple burger kitchen, we see people flipping patties, serving sodas, the usual. But I want you to completely reframe how you think about this. Do not look at it as a fast food joint. Look at it as a piece of highly lucrative, heavily optimized real estate. Because beneath the surface of the food service industry, that is exactly what's driving the real money here.
Which leads us to this totally fascinating, counterintuitive question. How does a burger chain achieve an 80% profit margin? Just think about that for a second. The restaurant business is notoriously brutal. Food spoils, labor is super expensive, competition is incredibly fierce. Honestly, most restaurants are absolutely thrilled to make a 5 or 10% margin. So, how on earth is this company pulling off 80%?
Well, that brings us to Section 1, the real profit formula.
First, we've got to grasp the sheer scale of this operation. At the time of this specific case study, they were operating 36,000 stores in over 100 countries. But here is the absolutely crucial takeaway. Over 90% of these stores are run as franchises. They're run by independent business owners, not by the corporate office. And trust me, that distinction, it's everything.
Let's look closer at that in Section 2, own versus franchise restaurants.
Okay, prepare yourself for this disparity, because it's wild. In a company-owned restaurant, the corporation gets all the revenue from the food, sure, but they also bear all the costs, right? The ingredients, the staff, the utilities. And the profit margin there, it's about 17%, which, hey, is really solid for the food industry. But then, look at the franchised margin. 80%. Wait, what? 80%? How are they squeezing an 80% margin out of the exact same burgers and fries? Well, the secret is, they aren't.
And that leads us to Section 3, the financial value drivers.
So the crazy thing here is that in the franchise model, McDonald's isn't primarily in the business of cooking food at all. They're actually acting as a highly sophisticated landlord. Yes, they get royalty fees based on a percentage of the franchisee's sales. But the real kicker? It's the rent. The company owns the land and the buildings, or they hold these long-term leases. And then they sublease those properties right back to the franchisees with a massive 40% markup. It's brilliant. They've engineered a system where they just sit back and collect high-margin rent and royalties, while the independent franchisee deals with all the low-margin headaches of actually running a day-to-day restaurant.
And when you replicate that landlord model across tens of thousands of locations globally, you end up with a number like this, $32.8 billion. That was their staggering asset base at the end of 2018. It totally proves that beneath the fast food exterior, this company is quite literally a veritable real estate empire. The physical land and the buildings give them incredible control over their franchisees, and it provides this vast, incredibly stable source of income.
Because of this structural setup, they achieve a return on invested capital, or ROIC, of 21%. Think of ROIC kind of like a financial high score. For a defensive, capital-intensive business operating in a super competitive market, a 21% return is just incredible. It sits well above their cost of capital, which hovers right around 6.2%. The engine is just humming along perfectly.
But, and you knew there was a but coming, this brings us to a huge pivot in our explainer. We've seen the sheer brilliance of the machine, but now we really have to ask, can this profit engine actually survive the future?
Let's explore that in Section 4, threats to the engine. We need to map out these internalization scenarios. See, right now, the cost of carbon emissions from beef production and the broad societal healthcare costs of unhealthy food, those are what economists call externalities. McDonald's doesn't pay for them directly. But if a carbon price is enforced, or if strict nutrition quality regulations get passed by governments, well, that leads straight to higher input prices. And higher input prices hurt profitability, they hurt the affordability of the food itself, and ultimately they hurt growth. Basically, these external costs get slammed right onto the company's balance sheet.
Let's look a little closer at those two looming roadblocks. Threat 1 is health. We're seeing a huge shift in consumer awareness around unbalanced diets, plus a very real risk of governments stepping in to levy taxes on salt, fat, and sugar. Then, threat 2 is the environment. Meat, and especially beef, has a massive carbon footprint and direct links to deforestation. If global climate change mitigation measures start putting hard limits on meat production, the affordability of that cheap, everyday burger is in serious jeopardy. Both of these forces threaten to completely dismantle the very core of their cheap, convenient customer value proposition.
Which brings us to Section 5, Recalculating True Value.
I really want you to treat this data as high-stakes drama, because honestly, for investors, it absolutely is. Let's walk through the math step by step. Before factoring in these environmental and social risks, the company expects a really healthy 3% sales growth and robust 43% margins. But after we internalize the costs of carbon and health regulations, sales growth drops by a full percentage point down to 2%. Margins take a severe hit, dropping 300 basis points, so 3% down to 40%. And because the whole business model is suddenly much riskier, their cost of capital spikes from 6.2% up to 7%. The engine is literally starting to choke.
And when you run those new numbers through a valuation model, here is the real climax of our explainer. The fair value of the company doesn't just dip a little bit, it plummets. Before ESG risks are priced in, the calculated value is $184 a share. But after those roadblocks hit the profit engine, the value drops to $129. That is a devastating 30% wipeout in the company's fundamental value. It shows that beneath the incredible 80% margins in the massive real estate empire, there is a deep structural vulnerability.
To wrap up, I want to leave you with this incredibly insightful quote from a master's student who analyzed this exact case study. They pointed out that while the company is definitely trying to adapt and become more sustainable, there is this profound contradiction between a strategy of true sustainability and staying true to their roots of selling cheap, fast burgers. It leaves us with a pretty provocative thought. Can a business model that was engineered absolutely perfectly for the economics of the 20th century actually survive the environmental and social realities of the 21st? The real estate engine is insanely powerful for sure, but those roadblocks ahead are very, very real. Anyway, thanks so much for joining me on this explainer. I really hope this completely changed how you look at those golden arches. See you next time.